Welcome to MoneyWeek Interviews. In this series, I will be speaking with a wide range of fund managers to discuss their views on the market and where investors can find the best opportunities today. I sat down with Tim Levene, CEO of the UK's only publicly listed fintech-focused investment company, Augmentum Fintech, to discuss the UK's booming fintech market and how the company is investing to capitalise on the major trends in the sector. I do hope you enjoy the interview as much as I did, and please stay tuned for more MoneyWeek interviews. Hi Tim, thanks for joining us.
Great to be here.
So to start, could you give us a bit of background on Augmentum, what it's set out to do and where it has found growth over the past couple of years?
So we've been listed on the main market as a closed-ended investment trust for just over 5 years now. We are the UK's only publicly listed fintech fund focusing on private, high-growth fintech assets across the European fintech ecosystem, but very much with the UK as the centre of gravity. And where we are today, we've got 25 companies in the portfolio. In terms of assets, about £300 million of assets. And our job really is to find those businesses just before they hit that growth trajectory. So we always talk about we access the inaccessible. And I think one of the motivations for launching the trust was really to open up the asset class, to democratize that access. So retail investors, institutional investors who really up until 2018 were finding it very hard to access a diversified portfolio of private high growth assets. And our focus really would be at what we define as a Series A. So these aren't pure startups. They are typically established, a year or two of trading. They have demonstrated what we would call product market fit. So they've shown some positive early signs with some strong early metrics, and really our capital is there to help get them to that next phase. I think the one thing to say though is we have to kiss a lot of frogs on that journey. We look at a huge number of companies. We've just done a piece of analysis where over the past 5 years we've looked at nearly 5,000 fintechs across Europe. So we're saying no 99.8% of the time. So we have to sift through that needle in a haystack. And I think what the private investor who might invest through SCIS or EIS doesn't have the ability is to have that full visibility of the whole ecosystem. So it's our job to really find those exceptional fintech opportunities that can have the potential to scale to be very valuable businesses one day.
There is a huge amount of potential there. You've given a rough estimate of how many companies you've looked at, but I mean in terms of the total industry, what is the overall market here? What could it be?
So it's a really good question. And I think one of the attractions for me when I first started in what was then just about being called fintech, disruptive financial services, was just post-financial crisis. And it is one of those industries that has been historically really slow to disrupt. Ironically, regulation is a great inhibitor of innovation. And post-financial crisis in the UK in particular, the regulator has evolved and changed. Successive governments have come in and recognized that competition, stimulating innovation is important. And we have seen a real progression in the market. But when you roll forward 15 years since the GFC, actually, when you look at the total market share that these innovators, fintech innovators have, not just in the UK, but across Europe, we're still talking about single-digit market share. So you might say, well, they haven't come very far, but when you look at the overall market opportunity, and we're talking about $15 trillion of global financial services revenue, so an enormous market, there have been hundreds of very valuable businesses built already. But actually, if you look at other industries and how they've been disrupted and innovated, many of them are 20-30% market share by innovators, in some cases, far higher than that. So there is a long way to go. And, we go through peaks and troughs in terms of sentiment, in terms of valuation. But fundamentally, I think over the next decade, we are going to see hundreds of incredibly valuable fintech businesses built here in the UK and across Europe that don't exist today, or certainly are in their infancy. So that's what's really exciting. We've established the market. We've proven out on numerous cases that there are businesses that can get to scale, that can demonstrate profitability. But if you look at the direction of travel, and if you want to transpose this to other industries, you can see that actually we're a long way behind. But therein lies the exciting opportunity for us and for other investors.
So you mentioned the UK there as being a very big market and a force in the fintech industry. So I'm interested to hear your views. I mean, you've been around in the fintech sector for a long time. You've got a lot of experience, especially in London. It's right saying that the country is a world leader when it comes to fintech, because a lot of people think about PayPal or Stripe or companies like that, and they say, "Oh, the Americans have got all the big names," but London is the beating heart of fintech.
I think it is, and I don't think it's an exaggeration to say that we are at the epicenter here in London, and that's really filtered across the UK as well. We've seen that pollinate into other major cities, and there are a lot of reasons for that. One, we've had successive governments that have recognised the potential of innovation in financial services. London in particular has a very long history as the global financial centre. And that deep DNA in our financial services ecosystem has really allowed a large number of innovative businesses to spawn from that ecosystem. But if you want to build an established, emerging financial services fintech ecosystem, you need collaboration, and you need collaboration from government and from regulators and from the central bank. And over the last decade in particular, you've had a very active role by the Bank of England, by the PRA and the FCA in particular, and multiple governments who have really worked collaboratively together. You don't often hear that the regulators are forward thinking, and of course there are elements of regulation that frustrate and hold back innovation. But I think if I compare what we've experienced here relative to the rest of some of the major European countries, I can point to France and Germany, they have really lagged behind in that innovation. Now, you have that triumvirate, but what you also need is the capital. And when you can add in the capital, the talent, and the key protagonists in driving forward innovation, then you have all the ingredients in place to really build out that successful ecosystem. And ultimately, what you need success stories, because success stories really breed the next generation of entrepreneurs. And ultimately, if you can allow those early investors to exit, to make a good return on their money, they tend to recycle that money back into that same ecosystem. And we've seen it in very specific cities, not just in the UK, but across Europe as well. When you have one outlier success story, that often becomes the catalyst for a large number of early stage businesses that launch. We can look at Klarna in Stockholm. We can look at Adyen in Amsterdam. We can look at the likes of Skype and TransferWise in Tallinn. Tallinn has more unicorns per capita than any other city in the world.
That's Estonia.
That is Estonia, exactly. So you need these outlier success stories. You need to celebrate them. They need to become heroes, because that really feeds back into the market. And I think we've had a lot of these in the UK. And actually, using the example of TransferWise, a fantastic business that was built in Tallinn, but really scaled in London and now listed on the London market. So London isn't just an attractive market for those that are living, working here. It's also an attractive market for entrepreneurs from all over the world to come and build their fintech startup, not just in London, but increasingly we're seeing the likes of Edinburgh, Manchester and Leeds become real hotspots for fintech innovation.
You spoke earlier about a $14 trillion global opportunity, and this is not always going to be the PayPals or the Stripes. There are going to be hundreds of smaller, less visible firms that do the boring back-end stuff that people are not necessarily going to see. How do you find those companies before everyone comes onto the opportunity?
Well, boring can be really good and profitable, and there is a lot of complexity and infrastructure in financial services. And actually, if you look at what the large global financial services incumbents have invested in infrastructure over the past decade, we're talking about trillions of dollars. The challenge for a lot of these large incumbents is that they have struggled to innovate from within. And a lot of that capital has been used pretty ineffectively. It's been used to prop up legacy infrastructure. So you've seen a real shift over the past 3 or 4 years in B2B, business-to-business propositions. And these large incumbents are much more comfortable in 2023 working, collaborating, becoming partners, customers, investors in these B2B fintechs because they've proven it out already on a large scale. The risk is lower. But I think if you think about venture capital, most venture capitalists tend to be generalists. And I think the attraction for us to be a specialist is, one, as you say, the size of the market is significant. 2, the breadth that you need to cover in financial services is significant. And 3, you really need to build that deep domain expertise to understand a deep level of complexity, whether it's in payments or asset management or digital banking or lending. And so, I think one of our competitive advantages has been really building up that deep domain expertise, where our understanding really resonates with founders, in particular in the B2B space, where we can talk sensibly and hopefully intelligently about some of the complexities in building a banking as a service infrastructure business. So, from our point of view, we get really excited by some of the boring because it is solving a very significant challenge for many of these large financial services incumbents. And people often say, well, isn't your job to disrupt them? And we're agnostic. We are going to back businesses that fundamentally disrupt traditional financial services players, but we're also going to back businesses that are helping the traditional financial services incumbents from being disrupted. And I think you've got to play both sides of the story, because the size and balance sheets of many of these large financial services incumbents is so significant that they cannot afford to fail. And so they are going to continue to invest and look to compete with the challenges that are coming their way.
So would you say these big incumbents, some of them have $1 trillion balance sheets, they can just buy the smaller fintech startups?
Yeah, and I think we have seen the M&A activity develop and grow over the past 2 or 3 years. Now, where we look in the past at some of these acquisitions that have happened, often small companies, innovative companies get acquired by large incumbents, and a lot of that innovation falls by the wayside. But increasingly, I think there is a recognition amongst some of the larger players that there's been huge innovation, and actually there is a real competitive threat. So if we think about what is the most established and disruptive part of financial services, payments is one, despite the fact that it's still sub 10% penetration, but we can point to the likes of PayPal, which was one of the first innovators, which in itself is being disrupted significantly by a number of others. But they have become increasingly acquisitive. The likes of Visa and MasterCard as well have been some of the most acquisitive players in the market, willing to pay a strategic premium. One, because they see some of the technology out there poses a competitive threat, but 2, the competitive threat of their significant competition getting hold of that IP leads them to really kind of look to use some of that very significant balance sheet to make that acquisition. And I think we're going to see more and more of it over the next 2 or 3 years. And we've seen a fair bit of it in our portfolio with the likes of Aberdeen, who bought Interactive Investor. The likes of NatWest just bought Cushion as well. So 2 kind of examples in the past 12 months, but I think many more to come across the industry.
Why do you think these big companies are not building their own stuff?
Well, they are. I think they are. They have been. If you look at the amount of capital that they have deployed in R&D has been significant.
But it's still not enough to really make a difference.
Well, they've really struggled to innovate from within. And that is because you're trying to move slow-moving oil tankers. These are large, complex organizations, in some cases with tens of thousands of employees, versus, the nimble, forward-thinking innovator that is only doing one thing, is totally focused, has managed to attract the very best talent in the market. And that is why you see some of these businesses emerge from the shadows that build on a fraction of the budget of some of the larger players, on a fraction of people, but they really are maniacally focusing on building the best possible product to solve a problem that's in that market. So I think you'll see the large insurers, the large banks continue to have very significant R&D budgets and continue to invest heavily on their balance sheet. But the failure of the last decade has demonstrated that they can't solve all their problems themselves, and they are absolutely going to do it through building from within, but also through M&A and through investing by buying equity in some of these innovative fintechs in the market. So they will play all three strategies in parallel.
So where, in your opinion, is the most boring opportunity? Interesting, boring, exciting?
Yeah, well, I think for me, there isn't one, but if I can point to an example of, products that are solving the problems of where the largest global banks have invested the most amount of money without significant success. So let's look at banking as a service as an example. We've got high profile examples of banks trying to build their own. They've built them, they've launched them, they've shut them. And I think that has been a real eye-opener for many of the banks. We've seen the likes of Monzo, Tide, Starling, Moneys, Revolut all build from within and build very significant.
So banking as a service is banking apps.
These are banking apps, but at the same time, some of these banking apps have started to sell to the banks themselves. So they're competing with them, and at the same time, they're selling technology solutions. And then you have standalone B2B banking as a service providers. And if you look at JP Morgan as an example, then Chase Bank has been built by banking as a service provider. The likes of Thought Machine are building a number of banks. In fact, I think Lloyds have invested into their equity as well. So
that's one company is building these back-end.
So there are a number of companies in the market, the likes of Moneys, Thought Machine, 10x Future Technologies, Mambu, are all out there solely existing to build back-end technology for banks all over the world who have spent the last 10 years, let's say, trying to build it themselves, and have recognized that there are several examples in the market of really successful next generation platforms that are operating with millions of customers. So the risk of saying, would this really work? Well, we absolutely recognize it's going to work. So I think, that's a really interesting, exciting area where there has been a lot of investment.
So it's interesting that you say banking as a service. I think a lot of people wouldn't put two and two together. There are these companies building banks that they've never heard of in their entire life. And that's going to be very hard for the average investor to find those companies. So how does an average investor find these companies of the future in the fintech space, which they've never heard of?
Well, I think comes back to the point I made at the beginning. One of the motivations for me was to open up this asset class where we can do the hard work, where we can sift through the market. And, I was talking to one of our shareholders a couple of months ago, and who had been quite an active angel investor in the tech market, not just in the fintech market. And I think one of his challenges, having been a very active public markets investor, was recognizing that much fewer of these businesses are going to the public markets. Companies are staying private for so much longer than they used to. The availability of capital, the attractiveness of frankly not being in the public eye, that even when companies do go public, some of the best fintechs that will go public one day will go at a price where a lot of that upside, a lot of that growth has already been achieved. And so the challenge for the retail investor who's waiting for some of these phenomenal fintechs to come to public markets is the vast majority won't. So if you look over the last 10 years, of all the fintechs that have exited either through IPO or through M&A, 95% have exited through M&A. So the public market investor is only seeing a tiny slither of the overall market opportunity.
And the ones that have gone public, what's the average valuation at the time of public?
I don't think I've got that data. We've seen very few in the London market in particular. We've seen a handful, and we've got the likes of TransferWise, which would, have gone public at 7 or 8 billion. The likes of Funding Circle that probably north of $1 billion. But we haven't seen a large cohort, and a lot of these, very compelling and exciting fintechs have been taken out either by private equity or by strategics. And so, therein lies the opportunity and the role that we need to play, where we need to identify these market opportunities. We give people the opportunity to come in at an early stage across a diversified set of fintechs. And, hopefully on that journey, we can pick enough of the ones that will really deliver that outsized return. And the challenge for us is, one, to sift through the enormous number. We talked about, nearly 5,000 that we've looked at since inception, but also be right, but not be right too soon. That is always the danger, where you can have a strong thesis, where you can have real conviction, but ultimately the market isn't quite ready to adopt that technology, either through banks who don't necessarily feel that they're ready to buy that technology, or through consumers who don't recognize that they're ready to switch from incumbent to challenger. So it's really important for us not just to identify the trends, identify the market opportunities. We've got to be ahead of the curve. We just can't be too far ahead of the curve.
So what markers are you looking for then for a company to invest in it? What markers show you that it's reached a level of maturity and is getting some uptake?
So I think for us, we talk about product market fit, and what does that really mean? And that for us is enough data, enough KPIs and performance indicators to give us a sense that this is a business that is starting to show real traction, that consumers or businesses that are buying this product are doing it because they can't see anything else of an equivalence in the market. At the same time, we have got to believe that this is a business that can grow to real scale. A lot of the businesses that we look at, we like the problem they're trying to solve. We struggle to get comfortable because actually when we think about how big can this business be is where it falls down. And so it can be a lovely business. It's just not a venture business. Right. For us, a venture business can be about delivering that outsized success. Is this a business that can grow from $1 million in revenue to 100 million in revenue? Is this a business that we can back at a 20 million pound valuation that can grow to 2, 3, 4 billion? Because when we get it right, that really can kind of deliver that outsized return to our investors as well. And that's why the bar is exceptionally high. And there is pattern recognition as well. Having been doing this for a long time, both as an entrepreneur and as an investor, you see the patterns, you know what great looks like. But fundamentally, even when we love the idea, the challenge is this a team that is truly exceptional?
It's people-driven as well as product-driven.
100%. You can have the best idea in the world. If you don't have a truly exceptional team that can execute perfectly, then the chances of success are really low. And I think that is always a misnomer, where people will invest on the back of, sounds like a great idea. When we've got it wrong, when I've got it wrong, it almost never has been because it wasn't a good idea. It's because we backed the wrong team. And somebody else has come and done it far better and executed in a better way and built a business. And it's no good being right about the idea. You've got to be right about the idea, and you've got to be absolutely right about the team that are building it.
One of the most exciting trends at the moment is artificial intelligence. And there are massive opportunities for artificial intelligence in fintech. It would be interesting to hear how you are seeing that unfold in your portfolio, and from your network of contacts, how that's unfolding in the industry.
Yeah, I mean, there's been a lot of talk and, frankly, hype around AI. We've seen a lot of capital flood into the space. I think it's really important for us to take a measured approach. A lot of our companies, our portfolio companies, have been using AI for years. In fact, we have a AI-driven business called Intellis in Switzerland that is leveraging neural networks for the foreign exchange markets. Our lending businesses, Zopa, iWalker, have been using AI, applying it to their lending models for years and years. So I think we're cautiously excited about the opportunity of machine learning in particular as a use case, both for our portfolio companies to continuing to use it and leverage it, but also for those AI-led fintechs. And so we're still very early in that journey. There is a lot of interest in the wealth management space at the moment. Can AI take the place of the wealth manager? Can it enhance the wealth manager in making better decisions? Can it make them more accountable? So I think for us, we can see a number of areas where AI is already being used very effectively, but also a number of areas where there is a lot of potential, but at the same time, there hasn't been that product market fit. But if, I'm somewhat of a betting man, having had a background many years ago in the industry, I would say that wealth management is one space where you will see increasing use of AI. The question is, will consumers trust it? Can they get comfortable? How long will it take for them to get comfortable? And what are those applications going to be? But it's certainly an area where we as a fund are spending a lot of time meeting interesting entrepreneurs and building out that understanding. But for now, it's a watching brief. We'll keep looking, we'll keep mapping the market, but it wouldn't surprise me that, in the next 2 to 3 years, we're going to see some real breakthrough players that we can call, AI-driven fintechs.
And then the other big area of focus at the moment for many people is climate and climate change. You've spoken a bit about how fintech is helping to improve the world and streamline processes. How is it helping with climate projects?
So there's a lot of capital going into climate, and I think for us as an investor, we need to find where climate overlaps with fintech. Clearly, there is a lot of requirement for data, for ESG data, for carbon trading platforms, for solar, the advent of solar, in terms of how will retail consumers that are going to start to store solar in those non-peak times on those battery wall units and selling it back to the grid. There's huge inefficiencies in that market already, and the UK is really starting to lead the market across Europe in how they think about that. So, I think there is a strong case where there will be more sophisticated platforms, trading platforms that arguably in our mind really will cross that fintech divide. So I think the industry can play a role in allowing consumers to benefit from becoming more carbon neutral, more energy aware, by building their houses to be more energy efficient and ultimately storing energy as well. So it is early in the journey, but at the same time, I think we're seeing some exciting early signs of innovation in that space. There are a lot of data platforms looking to be built. There is a lot of interest around carbon trading, but in renewables as well, and how that can be traded both by institutions, but also by consumers as well. So I think that is one area where you'll see a fair amount more investment capital go in over the next 4 to 5 years. I think the challenge for us is, again, finding that needle in a haystack. There is a lot of noise, there is a lot of innovation, there are a lot of people trying to solve the same problem with a similar solution. And, the challenge for us, again, is to really find that exceptional team that we think have a great chance to build that significant business.
So we've spoken about the massive opportunities there are. There's 14 trillion shaking up the financial sector. You've got opportunities with AI. You've got opportunities with climate change. But yet the trust trades at a discount to its net asset value. Why do you think this is? Do you think people are failing to see the opportunity here?
Well, I think the whole private equity venture capital listed space has suffered pretty indiscriminately over the past 12 to 18 months as a result of the shifting economic conditions, as a result of rising interest rates, with a perception that a lot of the underlying assets are overvalued. And, I think it's a challenge for us trading at nearly 40% discount, where we have demonstrated over the past year that when we have exited businesses, they've been at a significant premium to the holding value. That's the holding value, not the 40% discount to NAV. So I think it's frustrating for us because we believe we've built a really well-diversified, well-performing portfolio that over the last 12 months has grown on average on the top line, 100% top line growth in a very difficult economic environment. Another measure that investors often look at is what is that forward revenue multiple of these high growth businesses. And at the absolute peak of the madness, I can call it, in 21, we saw some listed SaaS businesses, fintech businesses trading on the market at north of 20 times forward revenue, and they were growing on average at 30-40%. So we've always looked at our forward revenue multiple and an average revenue growth rate, and currently it's trading at around 4.5 times forward revenue on a growth rate of 100%. And the long-term average in the listed market is between 7 and 8. So we feel we're taking a really prudent, conservative approach, despite the fact that our businesses continue, on average, to grow really well. So all we can do is keep putting runs on the board, keep demonstrating to investors that we are identifying some exceptional businesses at a really early stage, and that in time, they hopefully will grow to be very scaled businesses, and ultimately when they exit will deliver that, outlier return, as we call it. So it's hard to control the narrative. It's hard to control the discount. We recognise that the whole of the market is trading on discounts between 20 and, in some cases, 70%. And we would like the market to be less indiscriminate. It's up for us to continue to deliver positive outcomes, and hopefully investors can see through that and recognise that it's incredible value at the price it is now. And hopefully in time that discount will narrow and we'll move to a premium, and we go again.
That's great. Well, thank you very much for your time today.
Thank you.